King, it's a lot of suckers out here with their money, and you can't be no sucker out here with your money.
Bro, I ain't no sucker. Bet you I don't.
Okay. What's assets?
Assets are things that bring money into your bank account.
What's liabilities?
Liabilities are things that take money out your bank account.
Entrepreneurship is the act of becoming an entrepreneur. What's entrepreneurship?
Entrepreneurship is a process of setting up a business or businesses.
Taking on a greater than normal
Financial risk.
What's an entrepreneur?
Entrepreneur is a person that organizes and operates a business or businesses.
Also taking on a greater than normal
Financial risk.
What's financial mean?
Money.
And what's risk mean?
Chance.
Come on. What does it mean to own stock?
When you own a share of a company.
Come on. What's real estate investing?
Real estate investing is when you invest in a immovable property.
What's the two types of real estates?
Commercial real estate and residential real estate.
What's commercial real estate?
Commercial real estate is property for businesses and workspace, like an office, store, or land.
And what's residential real estate?
Property to live on, like a house, apartment, or condominium.
Come on. It comes with extra fees when you have real estate, you feel me?
Mm-hmm.
Daddy tells you how many times he pays his state property tax a year.
Once a year.
What's the type of maintenance fee?
Cutting grass.
Come on. What's HOA?
Homeowner association.
And what comes along with that?
HOA fee.
Come on. And when it comes to the brokerage percent, what percent is that?
7.
Come on. What's equity?
Equity is the difference between what your business is worth minus what you own.
Also assets minus
Liabilities and debt.
good job. What's credit report?
Credit report is like a report card letting you know how well you did by paying your money back you borrowed.
And how does credit affect your life?
The better you keep your credit, the more opportunities you'll have to get funding.
And what large purchases like?
A car or a house.
Come on. And always repay what you
owe.
Because if you owe somebody, that means you're in
Debt.
And you never want to be in
Debt.
Because that means you
Owe somebody.
And we don't never owe
Somebody.
because that ain't what suckers do, period. Come on.
Yeah, man.
You ready? Wasn't that a fantastic piece? That's what we talk about when we're talking about financial literacy. That's a father telling a son how to handle his money. And what he said is, don't be a sucker with your money. You know what I mean, Mike?
Very impressive.
Very impressive. Don't be a sucker with your money. Now remember some of the things we talked about weeks before. Be proactive with your money. You create the narrative when you're dealing with people and your money. When you're proactive and you're setting a narrative, it also means how do you negotiate? Ask good questions. A closed mouth doesn't get fed. Before I go any further, I want you to know that we have a special guest today. His name is Mike Romaine, and Mike is a wealth management advisor for Northwestern Mutual Insurance and Wealth Company. Mike has a ton of experience. As a matter of fact, he is one of my brokers. He's helped me quite a bit in making sure that I've made the right decisions when it comes to that side of my portfolio. So again, you can take control of your money. One other thing I want to mention, and we're going to talk about this a lot more in weeks to come. When you are negotiating, the best negotiators are not the ones, Mike, who do a lot of talking. The best negotiators are the ones who do a lot of good listening. There's a reason, and I know you've heard this before, that God gave you 2 ears and 1 mouth, all right? Because those who listen get information. Those who talk usually don't. And when you're negotiating, those who usually speak first, Mike, usually loses. It's a thing that's called golden silence. Ask a good question and shut up. Today, we're going to focus more on investments and insurance. Mike Romaine has done a very good job with his company, working for one of the best companies in the world that can help you with your investment opportunities and your insurance goals, both of which. So, Mike, tell me, share with people a little bit about your history and what you've done in your field.
Well, thank you for that wonderful introduction, George, and the opportunity to be on your show. I truly appreciate it. As you said, my name is Michael Romaine. I am a CFP, Certified Financial Planner. I've been with Northwestern Mutual for 16 years. I work probably 50-50 in the insurance and the investment world. I'm licensed in all 50 states, so I work with clients throughout the U.S. And we take on a form of holistic planning, which is trying to get people to look at the big picture, not just sell you some insurance or invest your money, but to take on an approach of today, midterm, and long-term planning.
Wow, wow. I've asked, trust me, Mike is a part of my team. I have a team of folks. Not that I have a ton of money, but I'm not going there. But with a little money I have, I want to make sure that I make the right decisions with it. There's a lot to be said, as we talked about weeks before, is that when you're out of debt and you can control what you do with your money, it gives you a sense of freedom. You know?
Exactly.
So I'm going to ask Mike a few questions. I asked our audience last week, send me some questions. What do you want to know? So these are some of the questions that I got from you guys last week. So Mike, share with us. There are different kinds of insurances. What is the difference between a term policy, a whole life policy, and a universal policy?
Okay, let me start with, a lot of my clients ask me, what's the best type or the right type of insurance to have? And my answer is the type that is in place when you die. So without knowing when you're going to die, it's very hard for anyone in my field to tell you the right type of insurance. So having a fundamental understanding of the different types of insurance will help you as the client determine what's the right type for you. We'll start with term insurance. Term is what we call a temporary fix. Term has a specific period of time that it is in place for. It could be 1 year, 5 year, 10 years, up to 30-year terms. Some term policies have level premiums, which means your premium starts off at $100 and remains $100 for the full 5, 10, 20, or 30-year window. Some policies we have at my firm go to the age of 80. No matter the minimum you can start is at age 18, and it'll go to age 80, but it has increasing premiums. Both policies have benefits, but both policies also have some cons to them. So you've got to make sure that whomever you're doing business with does a good job of educating you on the difference in a level and an increasing premium and the time periods. Term policies are liabilities on the balance sheet. The only way you will ever get a benefit out of a term policy is to die. And if you die, it's not a benefit to you, but it is for your family. Where is a term policy a good place for? Let's say you've acquired a debt, whether it's a mortgage, a business, and you want to make sure if you prematurely decease that that debt is relieved. So that's a great spot for a term policy. If we are trying to get income replacement, you're just getting into your swing, you're 30 years old, and you feel like that your income is very valuable to your family, and if you were to die in a tragic accident, we want to replace that $150,000 salary for the next 20 years because you've got a brand new baby. So we want to have a large amount of term. So term is what I tell people, a necessary evil. There are some places where having a liability on your balance sheet is beneficial. So that's term. Temporary coverage for a specific period of time. You're paying a much smaller premium, and that money is used just in case some of these things happen. If we look at the other side, which would be whole life. Whole life is a product that I tell people, one of the first questions I ask my clients is, how important is wealth transformation? And that's passing wealth from one generation to the next, maybe to your kids, grandkids, or maybe even your unborn grandkids. And if that is important, passing wealth, then I tell people whole life is a product we definitely want to bring into at least the conversation. I never tell people that you need that product, but I at least want to make sure you get the education. Some of the benefits of whole life are guaranteed death benefit. It has a fixed premium. It has a increasing cash value, guaranteed to increase every year. And through some companies, it pays a dividend, which increases your death benefit and your cash value. It is a liquid, tax-free growth place in where you can grow money, and it's not tied to the stock market. The elephant in the room, the majority of the time with whole life, is the premium. It is on average 10 times more expensive. So if I sold you $1 million term policy and you were the age of 30, and I'm ballparking this number, George, it's probably going to run you $50, maybe $100 a month. Well, $1 million whole life policy on a really good whole life policy, and there are different types, is probably going to run you a minimum of $1,000 per month. So most people say, why in the heck would I spend 10 times as much when both of them pay death benefit? And it really boils down to the features. And if you're looking at the features, why do some people buy a Yugo and some people buy a Mercedes? Because of the resale, the engine, the amenities on the car. So whole life has a lot of different features that benefit people. To wrap it up, you've heard about term, you've heard about whole life, and what most people say is, I like the benefits of a whole life, but I like the premium of a term policy, which is why they created a universal life policy. And a universal life policy is technically a term policy. It's a whole life policy built on a term chassis, which means that the price of the insurance does not go up, but the cost of it does. And that's what allows me to tell clients that it is a term policy, because the cost of insurance goes up on a term policy unless you level it out. So when you have a universal life, it's a hybrid product, and some people do like those. I've never sold one in 16 years. We do offer it, but it's not a product that's looked upon for the most favorable situations.
Good.
So
That is, I was not totally familiar with how universal policies work, so I appreciate that information. Let me ask, as it relates to whole life policies, would you consider that an investment, and if so, in what way?
absolutely not.
Okay.
I never tell people that whole life is an investment. The cash value component is the byproduct of consistently putting money into a policy. Your two most valuable assets in most households are your 401k and your mortgage. And the reason is because you're forced to put money in every month. So you put money into your 401k and it gets bigger and bigger and bigger over time because of the forced savings component. Well, your mortgage, the cost of the value of most properties go up every year, and because you're paying every month, what you owe, the liability sides come down, and it creates an equity. Well, permanent insurance has that same thing. You have a policy that you're paying on every month, and more and more and more of what you pay every month goes to your bottom line and creates an equity or a cash value that you have access to. I tell people it works hand in hand with the investment world. There's a term that says, there's a phrase that says, buy term and invest the difference. I truly believe in that. But if the market was down today, George, and you are a client of mine, which you've already stated, and you needed money, and we didn't want to go in and take money out of your brokerage account during bad economic times, well, you have a resource and a permanent cash value policy that's not tied to the market, that is liquid, tax-free, that you can access to go hand in hand with the investment. In the short run, you will be on the negative side in a cash value. You're 1 through 5, maybe 10, depending on how much you buy. About year 8 to 12 is close to where you break even. And after that is where it is profitable. So at this point, and I'm just throwing numbers out, you could be putting $50,000 in a whole life policy, and every year you're getting $75,000, $78,000, $90,000. So it turns into an investment at the end of the line, but in no way would I ever sell it as an investment.
Well, there's a ton of different companies and tons of different opportunities. It's a lot similar. You used the car analogy earlier. You know, it's like, what do you really want? tell me, and I want you to be as objective as you can be, how do you choose an insurance company? And tell me, what's it mean to be, because it's Northwestern Mutual, what's that mean when it says a mutual company as opposed to some other companies?
We'll push the second question to the back, and let's start with being objective and picking a company. To me, there's three things that you're really looking for. The first is the company. How is it rated with like the Better Business? How has the claims history been? Has it been known to try to shy away from claims? That's something that you can do your research on. The second is your advisor or your rep, or if it's insurance, your salesperson. That has a lot to do with it, because more than likely, if you have a good rep or advisor, you're going to talk to them more than you talk to the company. One of the things that I tell all my clients is that you're talking to me directly. If you were an investment client of mine and the market went down 40%, you're not calling 1-800, press 2, press 5, and you've got the wrong department and you've got to start this all over again. You're calling me directly. How available is your representative, and is he knowledgeable enough to be able to help you with things that may not be in his wheelhouse? Can he lead you to the right place? I have clients, and I've known George from the advertising world, radio. So I have clients that know that I have ties. They call me, who should I talk to at Mainline or Alpha One? George Demaree, Laura Wilson, Marlise Woods. These are things that you want. You want a knowledgeable advisor or rep who not only can help you in that space, but in other things, a connector. And the last thing is, what product are you looking for? So not only are you checking the company's background, you're checking the person's background that you're dealing with to make sure they're connected enough to be able to help you. And then can he get you to the product that you think you want, and can he educate you on the pros and cons of that product?
It's and then let's go to the second part of that question about mutual. I mean, what is that as opposed to companies that are not?
So there are two types of companies. There are publicly traded companies, which means that at the end of the day, when the company makes products, they have to return a portion of the profits to the shareholders, people who invest in the company. So sometimes their decisions on paying claims could potentially be skewed by what's best for the shareholders. A mutual company is a company owned by people that have policies with the company, and therefore, if you have a policy with that company, you are the shareholder, so the money doesn't go out anywhere, which means that it's paid in what's called a dividend, and the dividend increases your death benefit and your cash value. So it is great for the company to keep the mortality and morbidity expenses down and put those dollars back into growing the assets of the death benefit and the cash value. So when you look for a company, that could be a big decision maker. How are the profits paid? Are they paid to the shareholders? Or are they paid to me growing my things? How are decisions made based off of, are we going to pay this death claim or this disability claim? Does it affect shareholders or does it go back to us?
It's a question that I asked a number of years ago because just didn't completely understand how it worked. Share with me, what is the difference between cash value and dividend, or are they synonymous? Are they one and the same?
They're not one and the same, but they are. The dividend is a component of keeping expenses and mortality down. And when you do that, it is a return of payment, a return of surplus that goes back. It can go to multiple places. A dividend can be used to go directly to your pocket. A dividend can be used to push up the amount of the death benefit. It can be used to grow the amount of cash value. It could be used to reduce your premium. Cash value is the byproduct of the dividend, but it's also a portion of your premium as well, and the investment returns. So cash value is a pool of money that grows income tax free, that is liquid, that you have access to in times of need, or it could be used for retirement income.
Are dividends taxable? Is that a taxable form of income?
Dividends are not taxable as long as you don't take more than what you have into the policy. So if I have paid a premium of $10,000 a year and I paid it for 20 years, that's $200,000. If I pull more than $200,000 of dividends out, at that point they're saying, okay, you're trying to get your premiums back. Once you go above that, it starts being looked at as a loan. If you're not paying it back, it could be a taxable situation, but for the most part, it is not.
All right, so do companies who don't offer dividends, but a company was going to grow whole life policies as a whole, are going to grow cash value even if they don't also give you a dividend?
Correct. So, and I can really only speak very knowledgeable about the company that I'm with because
Right.
I don't want to misstep and speak about something that I don't know.
Gotcha.
So let's just talk about what I do know.
That makes sense.
If I do not put my dividends into my cash value still grows. Even though I have taken my dividend out or I have used my dividend to increase the death benefit, you can use it to reduce premium, but your cash value will grow. Companies have a minimum that they pay, and that minimum is what helps grow. So if you remember, I said the cash value is a component of the dividend, your premiums, and the investment. So yes, you can take a dividend and still grow your cash value. However, it will not grow as much or as quick without the dividend.
I've had my policy with Northwest since 1992.
Wow, I was still in college, George.
Yeah, I'm dating myself. And when I took that policy out, it was because I had young children and wanted to make sure that they were covered. So as time went on, I just kept investing in the policy and investing in the policy. Share with our audience, is there a time when policies are paid up, and what does that mean, and how are policies paid up in certain kinds of policies?
Okay, so a paid up policy is very similar to a mortgage. You can take out a mortgage, and it could be a 10-year mortgage, 15, 30-year mortgage. And when that time period is over, your mortgage is paid off. Same concept with insurance. So it is a paid up policy. You dictate the time. It could be a 10-year, 15, 20, to age 65, to age 100. And every company has their own time frame. But when that policy is paid up, you no longer are paying into the policy. They've essentially charged you more up front to pay it off at a much express rate. So just like with your mortgage. And when it's paid off, your death benefit continues to grow, your cash value continues to grow, and you're not putting a dime in it. Dividends are still coming. Everything is increased except your premium is zero.
Wow.
And you can also take a policy paid up. So one is paid off, one is paid up. So the paid up means that I'm scheduled to pay on this for 20 years, but I paid into it for 10 years. I'm making up a number, $50,000 in cash value, and I've run into COVID-19, and I no longer want to pay insurance, but I know I need it. So your death benefit is $200,000. You've got $50,000 of cash value, and all of a sudden you can't ever pay on this policy again. You can say, I no longer want to make a payment, but I need my insurance. And a company will say, okay, we will reduce your death benefit from $200,000 to $100,000, and you never have to make another payment. And your policy is paid up. So it's two different sides of a paid up or paid off policy.
So as you said before, there's a number of ways that people use their dividend. What do most people do? Do people use it? Or let me ask the question a different way. Let's suppose you have, just to simplify the math, let's suppose you have $50,000 in cash value, and I need a portion of that $50,000 in cash value. How can I use that money in a cash value to help me with a need or a want? If I just need to can I use that money to invest in something else?
Yes. So let's use me. when COVID-19 hit, I needed liquid cash, and I am very heavy into the stock market. And all the stocks that I had were depressed at that moment because the market dropped 40%. So I established a line of credit against my cash value. It's called a collateral assignment. I pulled from my line of credit to be able to buy stocks when they were depressed at 40% rate. So I have the option of paying my line of credit back, or I could sell the stocks now that they're up 20 or 30% from where I bought them and pay back my line of credit. The reason I established a line of credit outside of my firm is because if you borrow from some firm, the rates are 6 to 8%. When I borrow on my own, I got it at a 3.75 rate, and when COVID-19 hit, they reduced my rate to 2.9. So now I'm making really good money. But the cash value can be used for a multitude of things. One, I just want some money. You can go in and grab it. You can borrow against it, line of credit. You can pull the dividend. You can be used for emergencies. It can be used for retirement. It is a liquid, tax-free cash pile of money.
One of the things, a little sidebar that just hit me. We talked last week about the importance of a good credit number. That is important to have a credit rating of 700 plus. And when you do, you can make the decisions that you made, that his money did not cost him that much. If you borrow, as you said earlier, if you borrow from your insurance policy, that's going to be 6 to 8%.
If you go through the company, correct.
Right. But yet, if you have a good enough line of credit, then you can get money a lot cheaper than in any other scenario. That's good stuff.
Let me interject. You are
Please.
100% correct. But the difference is you are your own banker when you have a line of credit, when you have a cash value. And credit is irrelevant. They use the cash value and the death benefit as their collateral. So it is very, very important. Please don't hear this as I'm not saying credit is important, because I'm 100% with you.
Gotcha.
But having a cash value policy takes credit out of the picture, and you're still getting better rates.
Because that is a secured loan.
Secured loan. They basically use the death benefit. They know if I die, death benefit is paid. They are a lien holder on my insurance policy. If I live and do not pay my payment, they're going to take the cash from Northwestern Mutual because they have a collateral assignment against it.
All right, the next question is twofold.
Okay.
One is, what happens if you miss a payment? And the second is your company in particular, or most companies that you're aware of, are they also helping people who are affected by this pandemic?
So the first part we're going to answer is pre-COVID times.
Got it.
Pre-COVID times, you have a payment due on January the 1st, you miss it. You have up until 66 days to make that payment. After 66 days, that policy is considered a lapsed policy, which means that you no longer are covered. If you were to die, then they do not have to pay the claim. Now, that 66 days could be pushed to 90. There's some things that we do at our firm that's a little bit different, but on average, that is the window. Now, that's really speaking from the term policy perspective. On a whole life policy, if you don't make the payment, they can use your cash value as what's called automatic premium loan. And what that means is if you don't pay your premium, they can go in, pull that $200 payment out, and use that to pay your premium and create a loan against your policy.
Wow. So let's visit, because it seems that I have a lot more choices and opportunities with whole life policies. Whether you like them or don't like them, at least I got more opportunities with a whole life policy.
Options.
Options, I think, is the best word. Let's suppose you're to the point, you're 80, 85 years old, or maybe even less than that. You've got this insurance policy that you've had for many, many years. You have a ton of cash value in this thing, but you don't really need the insurance anymore. You know, all your children are grown, doing well. What can I do with that cash value at that point? Can I take it all out? And if I do, is it taxable income?
Okay, so let's stop and let me ask you a question before I answer yours. You say you're 85 years old, your kids are doing well, and they don't need the death benefit, correct?
Right.
You're late 50s, early 60s, you're doing pretty well. If one of your parents died, could you use the money?
Absolutely.
Absolutely, I know I could. And I say that because that is a misconception,
That's why I brought it
especially
up.
in the African American community, that when you're doing well, you don't need money. Then why do we go to work? So we always can use the money. You may not need the money, but you could definitely use the money, even if it's for just to pass to your kids. So I think let's keep in mind that just because somebody's financially doing well doesn't mean that they can. I tell people all the time, the wealthier people could use life insurance for estate taxes. At some point they will die, and those extremely wealthy people have to pay estate taxes on those millions or billions, depending on how everything is set up. And at that point, life insurance is an income tax-free benefit. So now let's answer your question. You've got $100,000 in cash value, you're 85, you don't need the life insurance, which we don't believe in, but you want to pass it to your kids and grandkids. So you can pull out up to cost basis. Let's say if you cancel it, anything above cost basis. Cost basis is what you put in the policy. To pull a number out of the air, you put $100,000 in premiums over those 40 years, and you've got $200,000 of cash value. When you cancel that policy, the difference in cost basis 100, cash value 200 is considered a taxable event. So we try to get people not to cancel it and pull it out. You can pull it out in a stream of income. You can take the dividends. You can borrow against it. Any of those moves are not taxable. At death, let's say you pulled out $160,000. At death, you die and you got $250 in death benefit. The company is going to take their $150 back, and they're going to pay out the difference between $250 and $150. I may have said $160, but easy math. $150 and $250, $100,000 will be what will be passed. One thing I always tell people: the beauty of my insurance, and I'm talking me personally, is to pass wealth for 2 and 3 generations down the line. And my kids are only 14 and 19, so I don't have any grandbabies. But, you know, in a perfect world, eventually I will be a grandparent, and I want to pass it. At the end of the day, I don't use my cash value to do anything other than spoil my kids while I'm alive. And I tell my kids, when I get to that point where I start accessing cash value, understand this is part of your retirement. I mean, this is part of the wealth transformation that I'm giving to you. So now you don't get $5 million when I am dead. We get to enjoy some of it together. So trips with the family and grandkids and things like that.
So again, we talked about, and let's go back to COVID-19.
Okay.
What's your company doing for folks who, as far as their premium is concerned, as it relates to this pandemic?
So they are allowing you to miss 2 months payment, and they are not lapsing policies that are those 2 payments behind. So you essentially are getting 3 months, maybe even 4 months, depending on the situation, in which your policy will not be lapsed.
All right, let's talk about, because time's moving on. A lot of good information, Mike. Thank you for being here.
Thank you for having me.
Let's talk about health restrictions. How important is it not to be a smoker, drinker, or whatever as it relates to insurance?
So life insurance is based on 4 major factors: male or female, tobacco or non-tobacco. Tobacco rates are double a non-tobacco rate on a term insurance policy. They affect your dividends and your cash value on a whole life policy. Age, it's better to buy younger. It's cheaper to buy younger than it is as you get older, because the premiums are based on how long they have until your anticipated date of death. So you've got male and female. Oh, and then health is the last one. The healthier you are, the more in shape you are, the cheaper your premiums is. We have a premium a rating structure. It starts off at Premier, your most healthiest in shape person. Preferred is down just a little bit, and standard is your normal person. I would assume standard would be us in this room. And then after that, it goes medical class 1 through 9, depending on, are you diabetic? Have you ever had cancer, stroke, BMI, things like that. So the worse health rating you get, the more expensive it is.
So,
and males are cheaper. Males are more expensive than females because females live longer.
the life expectancy.
Exactly.
Of women is a lot longer than men. We just do nothing. I'm not even gonna go there on I'll stop just short of that comment. So, we were talking about what it looks like when you're, as far as your health. We talked about what it looks like to take your cash value out. If you take out a loan or you take out some of your cash value, can you pay that back?
I would highly recommend that you pay it back. It is not required. And one thing that I tell people, and it almost seems to me that the insurance companies are not going to press you about paying it back, because the less you pay back, the more interest they're making. And if the loan, let's say you borrow $10,000, 20 years later, it's $40,000, and that's a stretch, but just for this scenario, all of a sudden, you're like, just forget the policy. I only borrowed 10, and then you walk away from a policy because the loan amount has increased, and now they don't have to pay death benefit. So, and I'm not saying that's what any company does. I'm just saying the way the rules are set up, you can call today, get a loan today, no questions asked, check will be deposited into your account within 48 hours, and you don't ever have to talk about paying it back. Just seems a little strange to me. So I always try to talk to my clients, but I think we understand people and we get in jams, and to hear that you don't have to make a payment, and no matter how I tell them the 8% interest rate, go get a line of credit, do this for lesser interest rate, sometimes it's just easier. And we know what happens when you take the easier road. So I just tell people, if you're gonna borrow against your policy, make arrangements to pay it back, because if not, then that number could balloon on you in years to follow.
Let's take at least, and this is going to be long, and we don't have enough time to really deep dive in it. But let's talk a little bit about investments. What kind of investments are available? And I'm going to be specific with your company.
Everything. The biggest thing I try to do, I tell people there's a great divide in our communities. And to me, it starts with education and investing. And they work hand in hand. And if you do not understand investing, more than likely you're not going to do college planning. And college planning is one of the things that I think makes it easier for our youth to be able to go to college if you're not getting a scholarship and if you do not want student loan debt. We've all been through this, at least I know I have, that student loan debt. I know you're a big-time athlete, so you might not have had student loan debt. But I understand student loan debt, and if possible, the investing will make a huge difference. Investing in general, the first thing I try to do is get a gauge of where my clients are. On a scale of 1 to 10, one of the questions I ask, on a scale of 1 to 10, in the investment world, how knowledgeable are you? 10 being you could do my job, 1 being you've never invested, 5 being I have a 401k, I'm contributing to it, but I don't understand. And that helps me understanding what language to talk to. If I've got somebody who can do my job, we talk on a very high level, we skip the beginner stuff and we get directly to the nitty gritty. If I've got somebody on the beginning, I do the ABCs of investing. This is an IRA, individual retirement account. There's a Roth, there's a traditional. This is a brokerage account. It's liquid, it's investing in mutual funds and stock. What are mutual funds and stock? So it's more of education than it is selling or putting people in something. You want to figure out what this person's trying to accomplish and give them 2 or 3 things that can help them accomplish their goal, the pros and the cons of those 2 or 3 things, and what the alternative is. You can save in a bank, And the money you put in a bank isn't ever going to grow, isn't ever going to lose. And that is what a lot of people's go-to thing is. I've got $5,000 in the bank and they feel like they're never losing any money. And I tell them it's something called purchasing power. And by putting $5,000 in a bank for 5 years, you've lost purchasing power, because every year inflation goes up and you're losing the purchasing power. And the greatest thing I can tell them is with gas. In '87, when I started driving, gas was 80 cents. We'll say it was $1. If I had $100, it would buy 100 gallons of gas. If I do not invest that money and I stick it in a drawer and I pull it out, in February, gas was $3. I could only buy 33 gallons of gas. I've lost the purchasing power of 67 gallons of gas. That's why it's important to invest, because you need your money to outpace inflation. So once we get a fundamental understanding of the why of investing, then we go into stocks, bonds, mutual funds, IRAs, annuities, permanent insurance. And I know it's not investing, but it does have the savings component, college planning, all the different things. So every tool available, options, calls, and that's over a lot of people's head, but every investment tool we have access to our firm.
When I think of investments, and Frank, and absolutely don't nearly have the experience that you have as it relates to that, I talk to people about risk tolerance. Mm-hmm. You know, what are they willing to risk? I mean, what does their heart allow them to do? So is there a certain age that you feel that you use, or is there a gauge or a sliding scale that you use to help people as it relates to their risk tolerance?
So age does play a factor in it, but at the end of the day, it's the individual person that determines their risk tolerance. We have an investor profile that we have our clients fill out, and that will tell me the time frame in which they're looking at. One of the questions is, how long until you need this money? 1 year, 1 to 5, you know, and then if somebody says, to give you an example, if it were you, and let's just call you 57, I don't know your age, but let's say
I'll be 64 this year, thank you.
Okay, so let's just say you're going to retire in 5 years. Then, of course, I would want your money in a less risky investment if this money is planned on being used in 5 years, because we tell people on average every 5 years you're going to have some type of financial disaster. 2000, 2001, 2008, and now 2020. So over 20 years we've had 4. On average, every 5 years we have a financial disaster. So we have to plan in those 5-year increments. So if you know you need your money in the next 5 years, we want to make sure if disaster hits, then you don't get hit too bad.
I'm going to ask you, because we have about 120 seconds left.
Okay,
all right?
I'll make the answer short.
So we're going to make it as quickly as we can. Let's talk about those folks who woke up one day and had $100,000 invested, and then at a blink of an eye, because of this pandemic, now they have 60. But they're still nowhere close to retirement. What would you share with those people?
Go back to sleep. Don't panic. It didn't bother you. If you're not using your money for 10 years, why do you care? If you put in 80 and it's now at 100, and then the next day it's at 60,000, go back to sleep, continue to invest, because you are now buying at a cheaper rate. If a house was on sale, if a car was on sale, we would jump on it. But when the stock market's on sale, we panic. Go back to sleep, find a way to put some more money in, and cash out in 10 years when you've rolled those depressed prices to the top.
That is good stuff. I hope that today has been very informative. Mike, Romaine, I am so happy that you decided to be our guest speaker today. There are certain things on here, though you and I have talked a number of times, that I need a refresher on. I think you should be a student of how you handle your money. Anything that's important to you, have an insatiable appetite for it. Go and find out. Ask good questions. And when you ask good questions, you'll find answers. Is there anything else? I want to share one other thing right before we close. Don't be, and I'm not going to use the name of a company, it's easy when you're sitting in the house and you have nothing to do to go online and start making purchases. Mm-hmm. Wow. You look up and you see boxes on your porch and think, where did that come from? Try your best to resist. I'm going to leave you with that. Have a good day. Stay safe. Wash your hands. Use social distancing. And always remember, give back. Dave Ramsey, the reason I love Dave Ramsey is because he always believes in giving back. Reach back and help somebody else. Thank you.